The US and Brazil are the two largest exporters of soybeans. China is the world's largest importer of soybeans.
Hmm.
China was buying all their soybeans from the United States just as a way to kind of make it up a little bit. Like, well, we got to buy the soybeans anyway. Why not buy them from the US to keep the US China trade deficit under control so it doesn't become too politically toxic? Well, as soon as Trump threw on the tariffs, China retaliated by moving their soybean orders to Brazil, stop buying U.S. soybeans. Well, that's not a phone call. I mean, you're talking about vessels, port facilities, agriculture, trucks. How do you get the soybeans to the ports? How many do you grow? Where's the fertilizer coming from? Et cetera, et cetera. And all those parties, the shippers, the cargo, the insurance companies, and so many people involved, banks, letters of credit, it's just a lot involved. They don't like short-term relationships. They say, okay, I'll do it. I want a 5-year contract. And China said, okay. So they reconfigured all those transportation lanes to get the soybeans from Brazil. All of a sudden, you're a U.S. soybean grower. You say, well, what do? Well, we start selling them to the Netherlands because the Netherlands needs soybeans too. So now instead of shipping them from like Port of LA to Ningbo and near Shanghai, we're shipping them from Port of Houston to, I don't know, France, or Marseille or someplace, or Rotterdam. So the point being, you completely scrambled all these supply chain relationships. I talked to the guy who, look, this is a worldwide endeavor, but he was probably the single most responsible individual for all the significant developments in the supply chain in the last 30 years. And he said to me, he said, Jim, you have to understand, it took us 30 years to build it. We blew it up in 3 years. It's not going to come back overnight. It's going to take 10 years or more to rebuild it. And what I talk about in the book is supply chain 1.0, which is 1989 to 2019, and then supply chain 2.0, which kind of starts now, but is going to go indefinitely because it's going to take a long time to put this together. It's it's like dropping a vase and it breaks in 1,000 pieces. You can't put it back together. You got to go buy a new vase. And that's what's going on with the supply chain. There will be a supply chain, there always is, but the new supply chain will look very different from what we've just come through. Because the whole 30 years of period I'm describing was built on efficiency, lower cost, lower cost, lower cost. It was kind of the Walmart model. So yeah, just-in-time inventory, everyone knows about that, but there's something called cross-stocking. That's where a truck pulls up at a warehouse and you unload it. Instead of putting the stuff in the warehouse, you move it to another truck that then goes to a destination. The stuff never goes in the warehouse. Inventories are very expensive. They're costly to finance. You got to move the stuff around. It's called picking. Pick the stuff off the shelf with you. I used to drive a forklift, so I know a little bit about it. And put it on a truck. I used to unload trucks too. So hey, I've got 7 suppliers. Why don't I cut it down to 3 and do bigger contracts with each one and get lower unit costs? I've got 5 transportation lanes. Why don't I cut that down to 2, get everything to Los Angeles and Seattle, as the case may be, et cetera. And they did it for 30, and they got costs lower, and Walmart and Amazon were the champions of this, but everyone else was doing it. But they missed something. What they missed was that while they were getting those unit costs lower for consumers, there were hidden costs, and the main hidden cost was you were creating greater frailty. This whole system was subject to a massive breakdown. So what happens if you have 2 suppliers and they both go on strike? What happens if you have one port of entry and it's backlogged? What happens if you've got cross-docking in warehouses and there aren't enough trucks? There are 80,000. We need 80,000 drivers. 80,000 drivers. Wish they'd hire them instead of these IRS agents. But the point being, it is breaking down all across the board. Now, can it be put back together? Yes, but the biggest difference between 2.0 and 1.0, this goes by different names. Janet Yellen called it friendshoring, and Macron called it a constellation of nations club, if you will. So you'll still have trading partners, you'll still have outsourcing, you'll still have transportation lanes, but it'll be members only. It'll be basically democratic, kind of liberal republics, Western Europe, the EU, of course, US, Canada, Australia, New Zealand, Japan, India, I would expect to be included. Friendly nations, but China's out. We're decoupling from them. They're decoupling from us. This isn't US driven. The US is participating, but this is what China wants too. Both sides are decoupling as fast as they can. China can develop its own network, maybe Central Asian republics, some Southeast Asian suppliers and so forth, but they're going to lose customers. Well, most of their customers actually in the United States. We won't buy their stuff and we won't sell them our stuff, particularly high tech stuff. So the world's going to break, and these new clubs are going to be formed, and there will be trade and there will be transportation lanes, but it'll be much more restrictive. Now, will prices be a little higher? Yes, but it'll be more secure. So the way I describe that, if you buy insurance on your house, or I buy insurance on my house, you don't want your house to burn down. You hope it doesn't. But if it does, you don't think your insurance premiums are a waste of money. Like when you write that check, you're like, that's money well spent. When you pay higher prices for consumer goods, the delta between the old price and the new price is your insurance premium for a more reliable system. And also, there's a big national security component to this. And I talk about Russia and Ukraine and China in the book. So that's all. So how the supply, what the supply chain breakdown means. Chapter 1, Chapter 2, what caused it, and we talked about that. And 3, where is it going? What are the constraints? And we talked about that. But then my editor, who's love working with her, she said, "Well, Jim, got to be a chapter on inflation." I said, "Of course we do. The supply chain breakdown is causing a lot of the inflation we see, and I'm going to write another chapter on deflation." And everyone's like, "Wait a second, why are you talking about deflation?" That's coming next. People are not ready for it. I know the inflation's here. I buy gasoline. I shop in the grocery store. I get it. I'm not. It's persistent. It's not transitory. I understand all that, but inflation has 2 major sources. One is the supply side, which is called cost push inflation. So that's energy price shocks. The stuff we're seeing coming out of Ukraine, fertilizer shortages, strategic metal shortages. Component suppliers who can't deliver stuff to factories in Germany and they're shutting down, et cetera. The other cause is from the demand side, and that's called demand pull inflation. Basically, it's psychological. Consumers pull demand forward. They're like, "Hey, I was thinking of buying a refrigerator. I better buy it today because the price is going to go up in 6 months." And in the 70s, we had both. It started with cost push with the Arab oil embargo, but it ended up demand pull. I was starting my career at the time. Your boss would just give you a raise. You didn't even have to ask. Inflation was going up so fast. Like, I better give this guy a raise. Like, here's another, $30,000 or whatever, because people would quit. And that sort of spun out of control until Volcker squashed it all. Right now, we do not have demand pull inflation. We don't. This is not what's going on. We do have cost push inflation. The difference is hugely important because cost push inflation from the supply side, which is, again, when I talk about in the book, it's real, prices go up, but it's self-negating. The old saying that, the cure for higher oil prices is higher oil prices, because when they get too high, people stop driving. They shut down various activities. By the way, if you're unemployed, you're not buying any gasoline because you're not going anywhere. I mean, that's kind of a nasty way of putting it, but that's how the cost push inflation, tips into a recession, and then prices come down. And we saw that in 1974. You had Jerry Ford and Alan Greenspan walking around with they had these win buttons, WIN, which stood for whip inflation now, except we had a recession and prices collapsed. Now it came back by 77 with for a lot of reasons, but right now we don't have demand pull, we have cost push. It will go away when this economy goes into recession. And then we're going to be talking about disinflation and deflation, which are, kind of close cousins. And the Fed's going to be out on a limb as usual, raising rates in the face of a recession and a price collapse. There were $1 trillion of subprime mortgages. These are mortgages that, no documentation, don't have to prove your income, very non-credit worthy. But there was a bubble mentality, a frenzy, and everyone, hey, buy a house and borrow money, fix it up, sell it for twice as much, walk away rich, and everybody was doing it. Mortgage default rates rarely get above 5%. 5% is really high in the mortgage market. So people were saying, smart people like Ben Stein, the financial analyst, but the central bank and others were like, well, okay, let's get crazy. Let's assume a 20% default rate, which has never happened, but just assume that's true. On $1 trillion of subprime mortgages, a 20% default rate would be a $200 billion loss, which was only slightly higher than the S&L crisis of the 1980s. Adjusted for inflation, it would have been a comparable loss. And the attitude was, well, we survived the 80s, we'll survive this. Yeah, it's bad
Banks will take losses, stock prices go down a little bit, but we'll survive. What they missed is, yes, there was $1 trillion of subprime mortgages, but there were $6 trillion of derivatives.
Yeah.
That was invisible. So all of a sudden, 20% of that was 1.2 trillion. So you create derivatives out of thin air, and there's no limit on how many you can have. They're off balance sheet, meaning give me the balance sheet of the company, I won't see them. You have to read the footnotes and then the information behind the footnotes. So non-transparent, unregulated, no limit on size. So the crisis was actually much worse than anyone realized. And then when it started to collapse, the contagion spread throughout the financial system. My point about 2008, it was because we did not learn the lessons of 1998, and we flew right into 2008. But once again, we have not learned the lessons of 2008, and we're going to fly right into the next storm. In 1998, Wall Street got together and bailed out a hedge fund. In 2008, the central banks got together and bailed out Wall Street. Who's going to bail out the central banks? In other words, the point is each crisis is bigger than the one before. The intervention gets elevated, larger dollar amounts. And are we now at the point where there's no one left to bail us out? And one of the questions I'm asked most frequently is, okay, Jim, I kind of follow your analysis on how risk works and how complexity theory and capital markets, how that works. But where's the crisis coming from? What's going to be the catalyst? It's actually a long list. Now, student loans, there are $1.6 trillion worth of student loans. So this will go, and kind of this gets to your point, Francis, how do capital markets and money markets and Fed policy kind of leach into debt and deficits? So when a lender, credit union, or anybody, or university makes a loan to a student, and the Treasury guarantees that loan, which they do, it's off budget. Again, it's not strictly a derivative, but it is non-transparent. So then the student defaults, and the credit union, the lender, simply turns to the Treasury and said, here's your loan file, pay me. And the Treasury pays the lender because they've guaranteed the loan. Now it's on the Treasury. But until that point, that loss is not on the books of the United States government. That loss is not part of the deficit. But when the Treasury writes the check to make good on the guarantee, it does go into the deficit. So we think deficits are high now, but there's this $1 trillion tsunami of student loan losses that's going to pile on top of the structural deficits and make it even worse. So all these things are, I spend all my time analyzing these things. I see them all. I can describe them. I can see how they're going to converge into a worse crisis. But in the short run, people either ignore them or they just don't know anything about them. But why would Bernie Sanders even suggest that? And by the way, he's not alone. I think the other candidates of, Elizabeth Warren and Joe Biden and Kamala Harris, one way or another, have suggested that they would do something similar, that we need student loan relief, and that ends up going onto the budget and onto the taxpayers. But there's a school of economics, and I talked about this in chapter 5 of my book. It's called Modern Monetary Theory, MMT for short. Everyday viewers, everyday people to know anything about it, but more to the point, economists don't know anything about it. This is a new school of economics, if you want to think of it that way. So there is this modern monetary theory, but the leading scholar of modern monetary theory is a lady named Stephanie Kelton, who's a professor at the State University of New York. But she's the financial advisor to Bernie Sanders. What modern monetary theory says is that actually there's no limit on the amount you can spend. You can spend as much as you want, and the market will either buy the debt, or if they balk, the Fed will monetize the debt. So how much debt is there relative to the size of the economy? This is called the debt to GDP ratio, but the way it's a simple fraction you learn in the 5th grade. How much debt divided by the size of the economy? So in a simple example, if you had $5 trillion of debt and a $10 trillion economy, that fraction would be 1/2. So you would say the debt to GDP ratio is 1/2 or 50%. Today, the debt is larger than the economy. That ratio is over 100%. We have round numbers, about $23 trillion of debt and about a $22 trillion economy. So the ratio is about 105%, highest since World War II. That troubles me, it troubles other economists. But my friend Stephanie says, what's the problem? You could take it to 150%, 200%, 250%. By the way, that's where Japan is. Japan's at 250%. Greece is 175% or so. Italy's 135%. They're all still standing. If you go to the Ginza, it looks like Times Square. So you don't see visible signs of stress. And here's the irony. Ben Bernanke would absolutely not agree with this theory, and he said so publicly. But Professor Kelton says to Bernanke, you proved our point. You were the one who took the Fed's balance sheet and quadrupled it from 800 billion to 4.5 trillion or so. You proved that you can print trillions of dollars of money without causing inflation, without causing high interest rates, without causing a run on the bank. So all we're saying is, you did it to prop up Jamie Dimon's bonus. We wanted to do it to forgive student loans. We may have different policy objectives, but the process is the same. What's the problem? Now, of all the things I've debated, for years I was dragged into Bitcoin versus gold debates, which I thought were silly. I mean, I don't like Bitcoin. I do like gold, but it's like fish versus bicycles. I mean, the debate never made sense to me, even though I did a lot of them. Of all the things I've had to rebut, this was actually the most difficult because it's superficially appealing. First of all, legally, it is true that the Fed can take their balance sheet as high as they want. There's no legal limit on the Fed's ability to print money. It is true that Japan has a much higher debt to GDP ratio, and they're still standing. It is true that the Treasury can borrow as much as they want, subject to periodic increases in the debt ceiling, which have never been denied. And the Fed can monetize the debt. So all the elements of the thesis are actually correct. So how do you refute it? And the answer is that legally it can be done. And if your goal is to print a lot of money and forgive student loans or give a guaranteed job or guaranteed basic income, whatever it is, in theory you could do that. But there is an invisible psychological boundary, and this is what the modern monetary theorists don't understand, and I don't think Ben Bernanke understands it. There comes a time when people wake up and they say, I don't know what's going on here. I don't have a PhD, but get me out of the dollar. It doesn't. And so, I'll buy gold, I'll buy silver, land, oil, natural resources, buy a new car, buy a house. Get me out of the dollar into something tangible, because I no longer trust the monetary authorities. I no longer trust the Congress. I can't believe that you're going to spend this much money without ceiling, without limit, without causing inflation. My inflationary expectations will go up. And the way to deal with that is to buy hard assets, starting with gold, but not exclusively gold. There, as I say, land, real estate, natural resources. They're all good. They're all good substitutes. At that point, interest rates will skyrocket. All of a sudden, the bond market will have difficulty selling it. The president of the Congress could take away some of the Fed's independence. All of these assumptions could come crashing down very quickly, very unexpectedly, and that's the problem with the theory.
People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power.
According to Jim Rickards, hyperinflation is coming to America, and the raising of interest rates won't be able to help fight inflation. In fact, it will make inflation even worse. Inflation will impact stock market as Jim Rickards think it will bring the economy into recession, and unemployment will go up to 4 or maybe even 5%. But all Jerome Powell can say is, too bad, that's painful and we have to get there, but we're gonna pay higher prices if we don't. And then there's the myth of 2% inflation. The Federal Reserve have something called inflation targeting, where if they fail to have at least 2% inflation per year, then it means the economy is going into deflation, or to put it simply, the economy is slowing down and therefore unemployment is going to go up and the economy will go into recession. In order to prevent that from happening, the Federal Reserve have to target the inflation to at least 2% per year in order to bring price stability to the market and to keep the economic wheel running smooth. At least that's the theory, but to Jim Rickards it doesn't make any sense. The Fed have raised interest rates way too high, but the inflation is not going down yet. In fact, inflation goes way up even higher than before. People said between 1913 and 2023, the dollar has lost 95% of its value, but we don't need to wait for another 110 years. Jim Rickards explains that in the 1980s, the dollar loses half of its value in just 5 years. Will it do that again? Will the economy goes into recession? Let's find out.
A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft, in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. But to your point, Addison, well, hasn't the Fed been raising interest rates? Yes, but real rates are still negative. So if inflation's 9 and the Fed's at 2, the real rate is -7. That's a really, really low interest rate. And if you say, okay, inflation's come down to 6 and the Fed's up to, 4, about 4.5 right now. So the real rate is now -1.5 in my example. Well, that's a lot less than 7. But still a negative real rate. We are not in the world of positive real rates. So then the question is, okay, how is the Fed doing at getting inflation to the target, the 2% we talked about, and explain why that's their number. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control. He said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know we'll probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so in other words, too bad, unemployment's going to go up to some number, I don't know what, 4 or 5%, which is pretty high. It's right now it's 3.4, I believe, the lowest since 1969. So unemployment's going to go up. The economy's going to go into recession, but too bad. That's the price we all have to pay to get inflation down under control. And the way to 2%, in other words, and the way Jay Powell rationalizes this, he said, yeah, that's painful, and we're going to pay a high price to get there, but we're going to pay a higher price if we don't. If we don't get to 2% and we let this thing spiral out of control and or even stay at 4 or 5% for a prolonged period of time, that the economic damage from that in terms of lost investment, misallocation of capital, basically people losing money on their investments, is going to be much higher than maybe a short recession.
Here's the interesting part. Jerome Powell scares the market with 6 speeches. He said the same thing again and again. We need to get to 2% inflation, which means raising the interest rates even more, and therefore we're going to have a recession and unemployment is going to go up. With the Fed being hawkish, the market should go down. Instead, the market got rallied because they believe inflation is going to go down soon. Jim Rickards thinks the Fed is already reached at something called the terminal rate, a rate which inflation will go down on its own, so the Fed won't need to raise the interest rates any further. But the Fed keeps raising it and making the economy crash even further. So how is it going to end? When will the Fed needs to stop raising interest rates? Let's listen to what Jim Rickards have to say.
So he said that the market didn't believe him. The market rallied. Went down a little bit right around that time, but then the market rallied in October. And he comes out at the end of September, gives another speech at an FOMC meeting, comes out November 2nd, gives another speech, comes out November 30th, gives a speech at the Brookings Institution, and then comes out in mid-December with another speech, and then again a couple of weeks ago on February 1st. So it's like 6 speeches in about 5 months. And he said the same thing every time. He said, we're getting to 2%, believe me when I said, we're going to have a recession, unemployment's going to go up, too bad, we have a lot of work to do, we're not done. The market has flipped on and off. Half the time the market doesn't believe me. Go, yeah, you say that, but in fact, inflation's coming down faster than you thought. You're probably, I should introduce a concept. I guess a lot of people have heard of it, but there's this new concept called the terminal rate. The Fed's trying to get to the terminal rate. And so what's the terminal rate? Well, no one actually knows what the number is. I don't know, but neither does Jay Powell. But it's a theory. And the theory is, okay, the terminal rate is a rate set by the Fed that's high enough to bring inflation down without further rate hikes. We get to a level, and that level is high enough that inflation will come down on its own just by waiting without raising the rate again. And the conundrum, I hate to use that word, but it is a conundrum. The conundrum the Fed faces right now is they have been raising rates and inflation has been coming down. Those two things are true. But is inflation coming down because they're raising rates, in which case maybe you want to keep raising them, or are you already at the terminal rate? It's coming down on its own, and now the danger is you're going to go too far. And that's the debate with Wall Street. And so Wall Street is sort of leaning to the view, now you're probably already at the terminal rate. Inflation's coming down. You need to back off. You need to stop and probably pivot. This was the famous word for the last 6 months. The pivot means you're actually going to have to cut rates because you have gone too far and you're going to cause a pretty bad recession. And so the expectation as recently as December was that the Fed would pivot around March or April. They would raise in February, maybe March, but pretty quickly after that, they would cut rates. And if the Fed's cutting rates, buy stocks. It's typical Wall Street analysis. It always ends with buy stocks, particularly tech stocks.
So, with the current high interest rates environment and reckless government spending, what should we do to protect our money from inflation? Should we buy stocks? And what stocks should we buy? The Fed said it will raise the interest rates even further, but the market thinks the opposite will happen. So who's right and wrong here? Let's hear what Jim Rickards think. Spoiler alert. This is not investment advice.
But the Fed has been saying the opposite. So there's been this battle where Powell goes 1, 2, 3, 4, 5, 6 speeches, says the same thing. We're not stopping. And Wall Street says, oh, yes, you are. So buy stocks. Well, who's right? Well, there's no saying on Wall Street, don't fight the Fed. I don't think of it as who's right or wrong. You could have an opinion. The way I think of it is I just want to know what you're going to do. Because if I know what you're going to do, then you can trade accordingly. You can plan for that and you can prepare for it. And what they're going to do is they're going to keep raising rates. Even if they're at the terminal rate already, I think they might be. Even if they are, they don't think so. Their opinion counts for a lot more than mine. And they're going to keep going. But by the time inflation comes down enough to say, yeah, okay, we're at the terminal rate, nice job, it'll be too late. They will have gone too far because the Fed's always the last to know. We're seeing something globally we've never seen before. And it is the best single indicator of a recession. The last time we saw anything like this was in 2007, just ahead of the 2008 financial catastrophe. So the stock market's saying it's all good, Goldilocks, soft landing, Fed's going to get the memo, they're going to cut rates, the pivot, and buy stocks. The bond market is saying, no, this is bad, and it's going to get worse, and it's actually too late for the Fed to do anything about it. But what happens is, as you get closer to the actual thing you're worried about, the inversion gets nearer and nearer. Now it is literally a month away or less. So that's like a big red siren, flashing light, whatever you want to call it. Interest rates are a lagging indicator. Everyone's like, well, how could interest rates going up if we're in a recession? The answer is, as you get close to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. Inventories are sky high and new orders are being slashed. You're not moving anything by truck. A lot of business people are living in the real world in real time. They know what's happening now, and the stock market tends to figure it out later. But as far as banking and credit is concerned, what happens is if you're a business person and you see business heading down, fewer customers, whatever, you go out and borrow all you can. You're like, hey, there's a really bad recession coming. If I got lines of credit, I'm going to use them up now. I don't want my bank changing the terms. I don't want material adverse average change clauses kicking in. Instead, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And they may pivot to say that there could be a rate cut. It won't be in April, but rate cut in August, maybe. I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened. They didn't look at the forward indicators I described, and they found out too late. Then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018, less than 3 months. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped. I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic. It dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing.
But real quick, I guess, let's stick on the recession just for 1 second, because there's the, bad recessions generally come along with a lot of job losses. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions like 08, like 01?
The answer is yes. First of all, we're seeing it already. So, I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6, on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. It's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. To say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights. Find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake. But you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree.
Right. You're in the military. Yeah.
You're in the, there's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment. I would increase my allocation to cash. I'll stick with cash, but let me kind of put that in a context. The most powerful investment tool we have is diversification. Problem is people don't understand what diversification means. So I run into people all the time. They say, well, I'm completely diversified. I own 50 different stocks in 10 different sectors, semiconductors, consumer non-durables, minerals, et cetera. And I say, you're not diversified. You may own 50 stocks in 10 sectors, but you have one asset class, stocks, which are subject to conditional correlation. In calm markets, they're idiosyncratic, but in panics, they all go down together, or in bubbles, they all go up together. So you're not diversified. So what is diversification? Diversification is having slices of asset classes that are minimally correlated. It's not probably not zero, but as close to zero as you can get. So what would that be? You'd have a slice of gold, but I recommend 10%. People, I have some strong views on gold, and I've written a lot about it, but people are surprised to hear me say 10%. Like, oh, Jim, why isn't it 50% or 100% if you believe all this? Well, I do believe it. I wouldn't say it if I didn't, but you don't want to be 100% in anything. You don't want to be 50% in anything. 10% is fine. If I'm wrong, you won't get hurt. And if I'm right, you're going to make so much money that it'll actually kind of be the insurance on the rest of your portfolio. But that leaves 90%. So I would have a large slug in cash, maybe 30%. And people say, well, wait a second, banks pay me 25 basis points, stock market's going up. Why would I want to be in cash? It's horrible. A couple of things. Number one, the stock market might not always go up. Cash is the opposite of leverage. So leverage increases the volatility of the rest of the portfolio. You'll get much bigger returns, but you'll have much bigger losses. If you have a slice of cash and you've got a volatile asset over here, which are stocks, and other volatile asset over here, gold's fairly volatile. If you got that volatility and you have cash, it will reduce the overall volatility so you can sleep better at night. Cash is a great asset in deflation. And if you're talking about inflation, which is here, then you got to deal with that. But don't rule out deflation. If we go into a recession because the Fed over tightens, or, the thing about the inflation, just a quick aside, it comes in two flavors. There's cost push and demand pull. Demand pull is when individuals are worried about inflation and they start accelerating purchases. Like, hey, I better go buy that washing machine right now because the price is going up, or better go buy that house right now because the price is going up. That's demand pull. Cost push comes from the supply side, not the demand side. And that's what we're seeing because of what we talked about, supply chain, energy cost. The Fed can't drill for oil. Raising interest rates doesn't get you more oil or natural gas. So the Fed can't do anything about it except kill the economy. Yeah, and that'll cool it off. But when you pay, I put gas in my car. I don't just read about this stuff. It used to be $45. Now it's about $75. Multiply that by 200 million cars across America. What happens is it reduces your discretionary income. If you're paying another $30 at the pump twice a week, then you're not going to go out to dinner Friday night. You're not going to, take a vacation, whatever it may be. So that depresses all those other areas. So there is this recursive function. So don't rule out deflation down the road. Not right away, but maybe next year. So cash. But here's the biggest value of cash. It gives you optionality. People don't understand this. What if I said to you, "Hey, I'll sell you a call option, an at the market call option on every asset class in the world?" You go, "Yeah, that sounds kind of valuable." Well, that's what cash is. When things are crashing, you're the one who can go shopping, and nobody's better at this than Warren Buffett. He's got his cash level at Berkshire Hathaway is at an all-time high. So there's a place for that. You can have some stocks, but I would look at the energy sector. I mean, I actually built and I own the largest non-commercial solar module field in New England. And I run my house off it. It produces about 7.5 kilowatt hours. So I know a little bit about it. And what I know is it doesn't work at night. It doesn't work in snow. It doesn't work in rain. It doesn't work in really cloudy days. By the way, you don't run your house off of solar modules. You run your house off of batteries.
Yeah.
And then the modules charge the battery. So you watch the battery level. That's how you manage it. So it works fine. But if you think you can run cities with that, forget it. So it's just not practical at that scale, even if you thought it was. And it isn't. That's very clear. But here comes, wind turbines and solar. I'm not against it. Like I say, I own one. But they're not scalable. They're intermittent. And they don't give you the base power, baseline power you need to run a modern power grid. Meanwhile, here's global demand. Okay, so the gap's getting bigger. It's not getting smaller. Renewables, whatever the pros and cons, are not closing the gap. The gap's getting bigger. There is no substitute for oil and natural gas and uranium. You got to put uranium in the mix. And hydro, if you live in Quebec, that's great. A lot of hydro, but not so much in the desert. And I've spoken to, without mentioning names, I would say you can go no higher in terms of who knows, let's just say board members of the 5 biggest oil companies in the world who said, yeah, as he said, we talk about that, but we can't say it publicly because we'll be, dragged, chained and dragged through the streets. But those are just the facts. So therefore, if you have an oil sector that's been bashed by the climate alarmists, but you can't do without it, which is true, buy some oil companies, when they're, so there's your stock portfolio. Private equity, venture, real estate, not commercial, but residential, yes. And, farmland, that's one of the hottest asset categories, and gold. So that's diversification. And that's the kind of portfolio you want, the kind of seasoned to taste. So the question is, will the Fed go down that path, do what they have to do the only thing they can do to subdue inflation at the cost of a very severe recession and something like a stock market crash? Or will they see that coming? They'll be the last to know. We'll all see it before they do, but they'll be the last to know. It's because they rely on flood models, and they're kind of in their own economic forecasting bubble, and they have very defective ways of thinking about the economy, and they're very much a creature of inertia. There are a whole lot of reasons why the Fed is not nimble. It's kind of quite the opposite. But they'll see it eventually, probably when it's too late. And will they balk at that point and stop rate hikes and maybe even reduce rates? That could save us from the recession, but that will just amplify the inflation. So rather than say which one's going to happen, I prefer to lay out those two paths and then just watch it very carefully. But more to the point, we've seen this movie before. This is a replay, and I think it's on, like you hit the remote control for double or triple speed. It's going to happen faster, but this is a replay of everything that happened from 2013 to 2019 and into 2020, which was, I'll just go through it quickly. So 2013, May, Bernanke says we're going to taper asset purchases. That's money printing, quantitative easing, whatever you want to call it. The market, tanks, bonds go down. Everyone's like, oh, it's over. Bernanke balked. But finally, in November 2013, they said, okay, the taper begins. They were still printing money, but at a slower rate, and that matters. That went on until late 2014. The taper was over. They stopped buying new assets. They said, okay, here come the interest rate hikes. Except they didn't come for another year. It wasn't until December 2015 that then Janet Yellen finally raised rates. And then another year for the second rate increase. So it was December 2016. So it was really, really slow. Took 2.5 years, but they got to 2 rate hikes. But then here comes Jay Powell. And then like clockwork, boom, 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 25 basis point hikes every meeting. And all the Fed was trying to do was to get back to normal. They were trying to get interest rates to maybe 2.25, 2.5, get the balance sheet down to, something like 2.5 trillion. They never specified it, but that would have been a reasonable level. So, okay, now interest rates are kind of normal, 2.5, balance sheet's down around 2.5 trillion. We're back to normal. We finally got through the global financial crisis of 2008. We undid all that stuff. Well, what happened? From October 1st, 2018 to December 24th, 2018, the stock market dropped 20%. That was the December 24th, 2018, we call it the Christmas Eve massacre. Stock market went down 3% in one day. But the Fed was tightening into the weakness, as they always do. And the last interest rate hike, it was December 16th or 17th, within a day or two, but mid-December 2018, they were still hiking and raising rates. And that was the last straw. And then the market just tanked. And then finally, Jay Powell got the message. First week of January 2019, he says, okay, that's it. We're going to be patient. Use the word patient. It's one of these code words. You have to get the code book out and see what it means. But patient means we won't raise rates again without giving you advance warning so you can get out of your carry trades or whatever. And then he went further and said, looks like we got to cut rates. And they did. And then by early 2020, here comes the pandemic. And then they took rates all the way back to zero. And then they started QE, 6, 7, call it what you want. They took the balance sheet to $7.5 trillion after getting it down to $3.5 trillion. So look at that whole sequence from 2013 to early 2020, including the pandemic. What happened? They tapered the asset purchases. They raised rates. They sank the stock market. Then they said, okay, no more rate hikes. Then they cut rates. And then they started QE. And by April 2020, where were we? Zero rates, back down to zero, and the balance sheet was $7.5 trillion after getting down to about $3.5 trillion. So that was a big circle. They ended up back where they started from. But the point being, they failed to normalize. They failed to get rates where they wanted. They failed to get the balance sheet where they wanted. They did sink the stock market. Okay, now 2 years forward, here we are again. What are we doing? They just raised rates at the March meeting. They're going to raise them again in May. And that's the easiest forecast I've ever made. 50 basis points, May 4th. Boom. You can count on it. And they're going to announce. By the way, I don't have a crystal ball. The Fed told us this. I mean, that's the thing about the Fed. They may be wrong, but they're transparently wrong. So they tell you what mistakes they're going to make in advance. So that's the Fed forecasting is actually fairly straightforward because you just have to believe them. So they're going to raise rates again in May, probably 50 basis points. They're going to announce a reduction in the balance sheet. Whether they actually start it in May, they probably will. 100 billion a month reduction in asset purchases. So that's QT, quantitative tightening. In other words, they're running the same playbook they tried to run, or they started to run in 2013, 2014. They failed the last time. Why do they think they're going to be any more successful this time? Why do they think they can get out of this? And the answer is, pardon me, the answer is they cannot without a recession. They can normalize rates in the balance sheet and they can stop inflation, but not without causing recession and not without causing a stock market crash. So the big question for the next year is, will the Fed do that? And they may. Or will they balk again, at which point you might rescue the market, but the inflation is just going to go wild. That's the debate. But the thing is about framing it that way. You've got two paths, and we'll get signals along the way. We won't be the last to know. The Fed will, but we won't. You'll be able to see this coming. The U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just, not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and we'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped down on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense. Not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So Treasury notes, a good 2-year note, a 5-year note, will perform very well, and they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term Treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for a 6-month Treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do, but how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. And so 2-year notes are a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, it's gone from, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are 2 different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building, and one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure, and of course Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder. He never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at the Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation, and it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called a cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. cost push inflation negates itself. You know, the old saying that the cure for high oil prices is high oil prices, because people can't afford it. Like, you know, maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons.